I feel that outlining sort of the economic picture versus the stimulus there has perfectly set us up to ask you why you've actually moved international equities to overweight.
Yeah, so we've been monitoring this for a while, and I think when we saw equity markets fall in March and to a lesser extent in February, we started seeing that gradual relative valuation attraction building between equities and bonds. And this is one of those things that we've always kept an eye on. It doesn't really tell you where markets are going over the next week, 2 weeks, or even next month, but it does give you a long-term impression. And actually, we were seeing the US earnings yield reach about 7.5%, and that was compared to 10-year gilts and 10-year treasuries, which were down around 0.5%. So when we're looking at those relative valuations, we thought actually this is an attractive time to start adding to equities. We also think that we'll see a short and significant shock from COVID-19, but it's not something that will affect long-term economic growth. And as a result, we expected markets to start to look through some of the near-term quarters in terms of the really poor economic and corporate data and look to a future which is slightly more positive, and particularly given it's supercharged by quite a lot of US fiscal and monetary policy.
Yeah, and in the notes you sort of sent through before the show, Ed, you were kind of saying that that is what markets seem to be focused on. They're eyeing the fact that this stimulus is going to outlive the pandemic, as it were. But I want to just take you to some thoughts from Gary Shilling that are on the Bloomberg this morning, because he really says that stock traders are in need of a history lesson, and he's talking about the Great Depression. He says this looks like a bear market rally similar to that in 1929 to 1930, with an additional 30 to 40% drop in stocks to come as the deep global recession stretches into 2021. He goes on to say on the subject of stimulus that the gigantic monthly and fiscal stimulus employed so far, with more to come, are unlikely to offset the massive disruption of the coronavirus pandemic. So I would ask you why you're not skeptical about the rally that we're seeing at the moment. Best month for US stocks since 1987.
Sure. I mean, I think there's a big difference between what's going to happen in the economy to what's going to happen in the financial markets as well. I think there is undoubtedly really poor data in coming out from economies at the moment, be that the US in terms of initial jobless. Obviously, we saw GDP from France, Italy, and Spain yesterday, all quite shocked. I would stress, I think, that when you look at this economic data, during the financial crisis, so to go back to kind of the most recent terrible stock market event, it took 200 days for the global equity market to fall into a bear market. This time it's taken just 20. So we're seeing this kind of concertina effect on economic data. So the economic data at the moment does look particularly poor. The question for markets isn't really how poor the data is and how deep the recession is, but actually how long this contraction in economic activity goes on for. So I suppose where we would question that would be saying, well, actually, if we do see a gradual reopening of economies, we see people start to get back to work, albeit it will take a little bit of time. We're more in the U-shaped recovery camp at the moment. We actually think we might see more of a financial market V, but the economy to come into a bit more of a U. And given that, yes, there will be this very sharp contraction in economic activity. We think it's temporary, and that's why we wouldn't be looking at this, necessarily catalyzing another major leg down in markets, because I think markets are a discounting mechanism, and will look to the positives which will be happening in future quarters. Might not even be that we get major earnings growth in 2020.